All right, so I want to put this quick presentation together called Be the Bank. My name is Nasir Zayed, and here I am. Oh, here we go. So about me, born and raised in Maryland, graduated Bowie State in 2013. I've been a professional athlete as a football player. I played corner. I've been an IT consultant, project manager, commercial debt broker for real estate investors, doing fix and flip as well as rental portfolios. And I've also been a real estate investor pretty much for about the last 6 years. All right. So my plan is to acquire properties with cash and relist and market properties on seller financing at a premium price. Um, Once I do that, we'll identify a buyer, get a minimum 10% down, and we usually hold a mortgage anywhere between 20 to 30 years. Right? So we underwrite them using an RMLO to ensure compliance with the Dodd-Frank statutes. And one of the unique things about how I structure the mortgage is that I will create a first and second note through that mortgage, so that way I have the liquidity and option to sell the first mortgage and keep the second mortgage in cash flow. So I sell the first to pretty much recuperate our cost basis on the acquisition, and then we can keep the second note and cash flow infinitely until they either refinance, sell the property, or pay it off. Um, with this model, I can sell the first lien note in 90 days to note buyers for pretty much 90% of the unpaid principal balance. Right? If I held it longer, anywhere between 6 months to maybe a year, I can pretty much sell the first lien note at par. Right? And then obviously keep the second position note in cash flow and live like a bank. So the target buyers are people that have income, down payment, job history, decent and good credit, but cannot qualify for a bank loan today. Those borrowers are usually people who are I-10, borrowers with no social security number. It can be foreign nationals. Since I'm here in the DC, Maryland, Virginia area, we have a lot of government workers, diplomats, you name it. There's tons of people coming through this area that aren't traditional fits for banks. Obviously investors, because investors are looking for ways to get properties at a certain price and at a certain leverage. And most importantly, self-employed borrowers. Myself, I know how challenging it is to get a loan from a bank as a self-employed borrower. And actually live in it. It's so much easier for me to get a commercial, but to live in a property and to do whatever I want to do with it, that's very hard to come by when it comes to bank financing. So pretty much we're looking for individual and families who are unbankable. All right. The property type that I go for are grandma houses, dated. They need cosmetic updates, anywhere between condos, townhouses, or single family. I like condos because obviously they're very hard to qualify for traditional financing. But obviously I'm very aware of the HOA and how the condo fees play into that. So I'm looking for great deals on that. And I'll show you one that I'm working on now. I'll also look at rehab opportunities where, again, they're light cosmetic. If they're more medium to heavy, that's kind of like not my wheelhouse. But if I can offer the financing on it and let an investor do it and give them a long-term window to do that, it's a great deal for them. I always source properties at least to be 70% below the ARV. I like to get properties under 200,000 here in Maryland. That's mostly like your Baltimore, the area that I live in outside of Clinton, Suitland, Maryland, PG County. They're kind of got these up and coming pockets that are like nice. The higher price neighborhoods are not my deal. I'm looking for properties under 200. Now, if I go to DC, I know exactly where to go so I can be under 400, because most of the properties in DC are starting at 200 to 400 where you can find a great deal. All right. And I always look for properties that have multiple comps to support the ARV within a quarter of a mile. And last but not least, I want to get properties where the rent rate is equal or greater than a mortgage payment. So if I can get a property for 150,000 and sell it at those terms to owner finance, and the payment with how I structure the mortgage payment is at or less than what rent would be, then we're in a good position. So for example, I have a property I'm looking at. It's $115,000 purchase, but it's $1,800 a month in rent. Well, if I bought that property and sold it on terms at 150,000, got 10% down, pretty much the payment for a mortgage is equivalent to what rent would be in that same location. So the benefit to us is that we have liquidity across the board. We're not leveraged. We get to take advantage of the amortization schedule that banks get to take advantage of. We have control over the note creation process as well as the property in this condition before we actually go in and structure the deal. We can do deals where maybe we get a property that might need a quick touch up, right? And so just putting in $10,000, $15,000 can have a significant increase in value and actually leave some equity on the table for a new buyer. And then we created even more value and created a higher note value relative to a property that didn't have any work to it, right? So we get the option of leaving properties as is and making money, or going in, putting in a light upgrade to it, getting a little bit more money for our note, and do it that way as well. And we also have a unique market position, because to be able to pull this off and do this the right way, you're going to dominate the marketplace, because nobody knows how to do this, and it's wide open for borrowers and investors who are looking for these type of deals right now. The stats show that almost 70% of people can't qualify at a bank today, but less than 5% of the marketplace offers properties on seller financing. And the seller carryback market last year was a $35 billion industry last year in 2023. So it's only going to get bigger. And last but not least, by buying the properties right, pricing them right, and going after them aggressively, we have multiple exits on the back end, whether we fix it and flip it, whether we sell or finance it, or maybe even hold it, right, as a rental. But again, I like to be the bank, but I structure the deals to where we have multiple exits all the way around. So benefits to the buyers: they get home ownership, it's easy qualifications, quick closings. If they're an investor, they can get unique financial and time leverage. If they're looking to do a fix and flip, maybe live in it, house hack it for a little bit, they don't have to run to a hard money source and have to play the refinance rehab game. They can just come to us. We set the payment today of what it will be based on owner financing, and they're locked in. And so they get the opportunity to do whatever they want and make the max value for their property. There's no prepayment penalties, no points, no miscellaneous fees, and obviously the tax benefits you get when you become a homeowner. All right. Now, the note creation process is based on a mathematical formula. I make sure all first notes are created not to exceed 75% ITV. I use this by using an appraisal report for any property that we buy. The note mortgage value, pretty much, as an example, would be based on a property for, if we buy for 100,000, as is 150K, and the ARV is 250, I'm going to make the note based on $150,000 as is value. Okay. And last but not least, the buyer must put down 10% or more in order to get and be able to own the property. And because I'm in Maryland, DC, Virginia, we're not the best state when it comes to foreclosure. So we can also structure this as a land contract for deed to minimize foreclosure risk. And we can also have terms within our paperwork process when we sell the notes that if there is a foreclosure, we can also have a right of first refusal to basically buy that note back. And there's other things that we can do to be very creative of how we deal with that scenario to offset the risk to our note buyers, but also keep us in a position where we can benefit if that happens. Also, the buyer in all cases will be underwritten by an RMLO, and the RMLO will pretty much give us over 500 documents plus 50 disclosures, notarized documents, everything back before we even take that to title and close with that buyer. So everything is done above board and all the documents are in place. Plus, we also have a servicing company as well to service the payments. So my note formula, how I do it, I base it on 0.69 to 0.72. So what that means is basically whatever property we get, 0.69 and 0.72 is the investment to value of where I write the note. So I'll show you this in another screen of how that looks. But pretty much all the notes are to be based upon 75% ITV. So if I'm at 72% or lower, then I know I'm at a good place in order to sell that note quickly. If I want to sell it day one, I would likely put a note at 0.69 or less, because that's where most buyers want to be if they want a table fund. But if I plan to keep it and we want to keep it longer than 90 days, then I'll be writing that note at 0.72% or higher, not to exceed 75%, so we can get that note sold at par later down the line. So the marketing plan that I do with any deal is before I acquire property, I market in Facebook Marketplace to see what hits it get. I just take pictures of the property that I've been to. I don't list the address or anything. I just say, hey, seller financing, and just see what people respond with. I let them know, hey, they need to have 10%. So that gives kind of, the marketing going before I do it. I also talk to people within the brokerage community as well as mortgage brokers who are dealing with clients that can't qualify. So I know exactly where I need to go. And, obviously I look for deals that have a good spread. And then if I acquire the property, the goal is to relist it on the MLS as a flat fee listing to get more traffic, and then do open houses and pretty much open the market to people who want to buy. In this area, we have such a dynamic background of different races of people from different cultures in the world. We've done in the past with my mentors that if you offer on seller financing, buyers will actually come in and give you cash at the seller finance price. They like that because they know you're not traditional, and They just want to do a deal to where it makes sense. So some people don't want to deal with banks, some people don't want to deal with interest, and some people, they want seller financing. So that's the beauty of being able to market as a seller finance property. The risk obviously is foreclosure, mispricing of property values, note seasoning depending on the plan before we sell that note, and obviously it could take up to 6 months to identify a buyer if the property pricing is not attractive. So the goal is to be able to offset all those risks up front once I know how we want to acquire it and where we're going to be doing and how we're going to hold that note and what's the ultimate game plan. So here's my mentors here. This is Nick and Eric Sage, and that's Jory Austin. Nick over here, he's one of the leaders in the space for creating notes as an originator. He had a company that he sold to a federally chartered bank that's been in business over 100 years. He's done over 1,200 note transactions. He primarily does deals in Texas. This is Eric Sage, his partner. He does deals in Arizona. And this is our good friend Jory Austin. He's based in Puerto Rico, and he does deals here on the East Coast in Pennsylvania. And I've learned from both of these guys for about the last 6-7 months to understand the process, how to do this. And since I met you, Greg, I want to let you guys in on this type of deal so we can make some money together. All right, now in the next video, I'm going to show you how I do a deal.